It's too early to tell. What we are paying attention to is the very rapid growth and participation from various parts of the financial system. The private credit managers like to say that it's good that private credit does not take deposits, but it does link to the banking system. We've done research that roughly 30 to 40% of financing, particularly in the private credit direct lending market, actually does come from banks, so there are interlinkages to the real financial sector as well. That's the question du jour. There is a number of pundits who are projecting, 2.7 trillion by 2027 or even 3 trillion by 2028. It all depends really on the rate cycle. So it all depends how long, first of all, how higher will be in terms of rates and how long. If we are kind of circling around the base rate of 5.5, that's very much a possibility. North of 6% is probably harder. Because what we've seen is that all the LBOs that are happening these days are actually happening with less leverage because of the high rates. So that's the trade-off. Yes, there's a lot of dry capital, around 200 plus billion in private credit that can be deployed, but on the other hand, the sponsors are using less leverage. We don't think it poses a heightened risk. I think it's actually a very prudential way how they've structured some of these new ventures. For example, Wells Fargo has a partnership with Centerbridge and is actually done in a way to really participate more with middle market borrowers that are existing in penetration of new clients, so not necessarily with sponsors. So it's actually core of what a commercial bank should do. Some of the other announcements that we've seen are really within the asset management arms. Goldman Sachs, Morgan Stanley have had for a number of years private credit strategies within their asset management businesses. Deutsche Bank recently announced that. So what we think it's going to be, parallel investment of the asset management franchises with third-party investors and not really posing increased risk. Thanks for asking me this question. I've been on the media trunket quite some time to explain this. And I don't think it's inconsistent. I'll explain why. First and foremost, private credit definitionally is north of $1 trillion. The BDC industry is 200 billion or so. The BDC industry is the most transparent lit part of the BDC market, and we really don't know what's happening in the rest of the private credit universe. We do cover probably around 90% of the BDCs from a ratings perspective, and we have a very good overview within their underwriting standards, governance, loan portfolio performance. And how we square that is that with some of these funds that we recently put on positive outlook, including Golub Capital, Blackstone, Ares, there is a lot of historical franchise value in these businesses. For example, Ares has been definitely cycle tested. Golub too has been through a number of cycles, one of the first big private credit lenders. Blackstone is a relatively new player from a BDC perspective, but it's kind of one of the original private credit, if you will, originators through the GSO franchise. So, and we think about who has been cycle tested, who has a private equity arm that can, to the extent the lenders in a down cycle have to take the keys of the sponsored companies, who can actually have an ability to run them. And definitely these franchises have that ability, particularly the Blackstones of this world, Sixth Street, which is the other fourth name I didn't mention, and Ares. They have very significant private equity arms, and they also have restructuring teams that they really know how to deal with a down cycle. So that's how we differentiate it, and we think the BDCs are a relatively transparent part of this universe, and some of them have an opportunity because of their size, good funding, and ability to really run the companies to the extent it gets to there to be able to extract the most values for their investors. Well, we just wrote a piece actually about the BSL market reopening. We've had pretty much a dry sprout for since March of 2022. And year and a half of a very relatively weak kind of start and turn, area in BSL, and it's really been kind of where the CLO market has been, because a lot of the BSL deals end up basically in CLOs. So it's really a function of what the market needs, and private credit has capitalized on that. And actually, by our analysis, private credit has surpassed the BSL market in 2023. So will this stay? We think that there will be some equalization. The BSL market is ready to open. The banks do have appetite to participate. The CLO market is reopening, but private credit is here to stay and will keep taking market share from the BSL market.